Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we have an exciting episode that's focused all around a recent new ETF launch that we've done here at BMO ETFs. So our goal here is always to continue to innovate, to give investors the tools to build better portfolios, but also the focus has always been around bringing broader access to some of these differentiated strategies that were previously only available to sort of a select amount of investors, whether that be institutional or capital markets clients. So democratizing investing. And this has led us to launch Structured Outcome ETFs. So both Buffer ETFs and Accelerator ETFs, which we're going to do a deep dive into today. Now, I totally understand that these are probably new words to you. These are relatively new to the marketplace here in Canada. And for many investors, it might be the first time hearing about buffers or accelerators, but these ETFs deliver really a whole new range of potential outcomes, which is going to allow investors to either, in the case of a buffer ETF, dial down their risk, their equity risk, or in the case of accelerators, dial up their equity exposure and potential returns. So before we do get started, a quick reminder that we're not providing investment advice or recommendations today. Today's episode is all about providing education around a new ETF solution available to Canadian investors. And joining me today, I have Chris McKaney, Portfolio Manager with BMO ETFs. Chris has over 2 decades of experience in the industry and is totally focused all around our derivatives-based and equity-based ETFs here at BMO ETFs. So welcome back to the channel, Chris.
Thanks, Erin. Glad to be here.
Can't think of a better expert to have on. So let's dive right in today. We've got a lot to cover. We're going to start off with buffer ETFs. So many investors out there today, especially given where we're at in the markets, want to keep that growth potential, that equity exposure in their markets, or in their portfolios, but they don't want to take on the full risk in their portfolios. So walk us through how a buffered ETF delivers on this investor need and how they can be used in a portfolio.
Sure, yeah, and I think it makes sense to think about the traditional approach to investing. Typically investors that don't want the full risk of the equity market dominating their portfolios would allocate a portion of that portfolio to fixed income, right? And that's the classic 60-40 portfolio, 60% equities, 40% fixed income. And that gives investors that growth potential, but at a lower risk level typically than what the full equity market provides. I think a lot of investors realized and learned in 2022 that is not always the case, right? When equities are going down, fixed income isn't always going up in order to provide that offset to that risk. And so investors may want to consider taking a look at a buffer ETF that provides a more explicit protection against the equity market downside potential. Instead of having an allocation to fixed income that you hope will go up when equities go down, a buffer ETF uses an option overlay strategy that provides that explicit level of protection. So you can be certain when you're holding that buffer ETF through that entire outcome period, and we'll talk a little bit about outcome periods going forward, that you will have absolute protection against equity market downside. In the case of BMO's buffer ETF offering, we provide a protection level against that first 15% of equity downside risk. And so again, for investors that want that equity growth potential, but don't want that full level of risk, or are concerned maybe of continued volatility or equity down markets, having that allocation to a buffer ETF, again, gives you that explicit level of protection and lets you sleep at night knowing that if there is more downside or more risk in the equity markets, you will have some protection against that.
And like our cover call strategies, being an option overlay strategy. In our covered call strategies, investors typically trade away some of the upside potential for that enhanced income stream or that reliable cash flow stream. Buffer ETF investors are willing to trade in, again, some of that upside. So if we could talk about the cap for added downside protection, as you just walked through. But walk us through how that actual option strategy is working behind the scenes when it comes to a buffer ETF.
Sure. Yeah. Happy to get into the nuts and bolts a little bit of the options themselves and how we're using them. Maybe I'll just talk about how we build the portfolio overall. There's a couple of steps to it. And first of all, what we want to do is gain exposure to the underlying market. And again, in the case of BMO's buffer ETF offerings, that is the S&P 500 hedged to Canadian dollars. So our ETF ticker ZUE offers that exposure. So the buffer ETF goes out and gets that exposure to the equity markets. And so that's the first thing that investors want to know. Then we add on this option overlay strategy. And what we do is the first thing we do is we buy what's called a protective put spread. This is a package of options that have 1 year in tenor and provides that protection against that first 15% of losses. So if you think about when this put spread is purchased, and again, there's an outcome period associated with this, which is defined. And so you can think of September 30th, the last day of the year, the last day of September, being that point at which that protection level is set. So wherever ZUE, that S&P 500 is trading at the end of September, we're going to provide the first 15% protection against any downside there. That's what that put spread does. Now, there's a cost, of course, to providing that protection. Otherwise, everyone would go out and do it all the time. So there is a cost to that put spread. And if you didn't fund that cost, you would have a drag on your returns. So the next step we do with this buffer ETF is we sell an upside call option. And you referenced covered call ETFs. Many investors very familiar with what we do there. We sell those upside call options in order to generate cash flow in the portfolio. With covered call funds, we simply distribute that cash flow to investors to get that income stream. But with the buffer ETF, we're taking that cash that we're generating from selling that upside call, and we're using that to fund that put spread. So that overall options package becomes a costless package to the investor. And the result is a portfolio that, again, if you hold it through that 1 year outcome period that the options are active for, will provide that protection against that first 15% of losses. And it does have the impact of capping your upside potential. Let's call that in the neighborhood of 10.5% or so is what we've seen for our first iteration of our buffer ETFs. So again, investors are willing to trade that upside in order to get that downside protection.
And you mentioned our first iteration, so we will see more of these coming to market, but ZOCT, OCT for October, is our first ticker. That's the BMO US Equity Buffer Hedge to CAD ETF. So the reference asset, of course, as Chris mentioned, ZUE. They have a 1 year outcome period, so we will be coming out with more so that you can participate going forward, but that's the first one that we've listed October 1st. I think what's really cool about these ETFs is that they provide really all the same benefits as an ETF, right? You're getting all that transparency, that diversification, but you're also getting that intraday liquidity, which is not really inherent in this strategy, from a historical perspective. So investors can choose when to move in and out of the buffer ETF, just like any other ETF, even with that predetermined 1 year outcome period that Chris mentioned. But Chris, I think it's important to note what investors should be considering around trading these ETFs intra-period within that 1 year period.
Yeah, that's a great point. And again, let's go back to the structure of this solution. And the ticker actually is very helpful in that regard. ZOCT, that October, gives you an idea that this ETF resets that hedge, that buffer, every October. And so investors that want that full 15% protection and that certainty around that need to hold the ETF from the 1st of October all the way through the end of the outcome period at the end of next September. Now, as you mentioned, this is an ETF. So the great part of this is there's liquidity there, not only daily, but intraday. And so you don't need to hold the ETF for that entire outcome period. You can move in and out of that at any point. So I think I'll go back to the original point where that option structure we put on is good for a 1 year period and is based on the values of ZUE or the S&P 500 as of the end of September. And so as we start to move throughout the year, of course, markets go up or down, and we've seen them going down recently. And so investors should know that what started out as a 15% buffer, if you haven't bought into this ETF yet and the market's down a couple percent, the remaining buffer might only be 13% or 14%, for example. At the same time, that cap that started at 10.5% may now be 11 or 12%, again, based on where the market is moving throughout time. And so investors probably just want to have that in the back of their mind that before you go into this strategy, if you haven't bought it on the first day of this outcome period, maybe just take a look at where we are relative to where that cap is going to be and where the buffer level is set at. That buffer zone, of course, being the most important for these conservative investors. So again, it's just one extra step investors might want to take a look at before getting into this strategy, if they're going to get into it before the outcome period starts. Similarly, if you want to sell out, before that outcome period ends, you want to know generally where you are within that range as well.
Yeah, so it's definitely important to note that buffer zone and the cap, it's set at the beginning of the period, but as you mentioned, during the period, that value is going to change. So you have to hold it for that full 1 year to actually realize that full 15% protection. I also wanted to highlight for investors who are looking for more information intra-period that we do offer a lot of transparency around and a lot of great data points to look at around that on our website, bmoetfs.com. So you can see the remaining outcome period, the start and end dates, the cap and buffer zones, and the potential performance outcomes on a daily basis. So really a lot of transparency provided by these, and encourage anybody who, especially if you're looking at these intra-period, to review that PDF that you can download if you're on the ZedO page there. Chris, walk us through what happens at the end of the outcome period. Once 1 year is up, what happens to investors in these products?
Sure. At the end of the outcome period, as you say, the options package that we've put on expires and matures. And so, based on where the market has moved, that will create either a gain or a loss in the portfolio. And at the end of that period, we simply reset that option structure for the next outcome period. So for another 1 year going forward, we'll provide a 15% buffer level against wherever the market is trading at that time. And we'll have a new cap set based on what the cost of that put spread is going to be. So, we talk about protection levels, we talk about caps. I think it's important to understand that each outcome period, each time we reset the option package, that cap is going to be a slightly different number. Of course, we want that to be as high as possible, but really it's based on the market pricing at the time, based on volatility, based on where markets are trading, based on interest rates. And so again, that cap is going to change every outcome period. And so we want to know as investors going into a new outcome period, what's that cap going to look like? What's my new trade-off going to be to have this 15% protection level in place?
When do we expect the next ticker to come out, or how frequently are we going to be listing new issues of these?
The goal is to have one of these that would reset that options package every quarter or so approximately. So think of, if we launched an October ETF, we might launch one that hopefully resets in January, and then another one in April, and another one in July. And so every 3 months, you'll have a new 1 year outcome period that you can choose to either participate in or stay in whatever other investment you're in. And so again, every 3 months, you'll have this new trade-off to decide if that's what you want to invest in.
Makes it a great portfolio construction tool for sure. And, the way to use these, you can use them as a core equity solution for those more conservative growth investors, potential hedge in your portfolio if you think markets are about to sell off, also as a tactical position in a portfolio. So lots of ways to look at these new ETFs. Before we move on to accelerators, I did just want to mention that we will be discussing these on future episodes. So if you have questions, which I'm sure you do, just put them in the comments below, and we'll use that to inform inform future content on the channel. So please add your questions below. So let's move on to accelerators, Chris. These are really built for investors who are more constructive on equity growth over the next 3 months or so. But they're not really willing to take on additional risk in their portfolios as money as leverage would provide if you're looking to get that accelerated growth. So it's really about dialing up your equity return potential. Let's walk through how accelerator ETFs work, Chris, and how they fit in a portfolio.
Yeah, I think it's really important for investors to consider many different approaches to investing, particularly where we are in the market and going forward. With the potential of equity returns being a little bit lower than they have in the past due to central banks trying to engineer economic slowdowns. There's a lot of fears of a recession, over the next year or so. And I think whether there's a recession or not, there is an emphasis on trying to slow down economic growth, and that can tend to lead to lower overall equity returns. At the same time, equity market volatility is expected to stay relatively high. Interest rate volatility also expected to stay relatively high, whether rates themselves are high or not. The movement of those interest rates has an impact on equity markets as well. So strategies that might have worked in the past in a very low rate, low vol environment where you could leverage up your returns, as you mentioned, Aaron, with very cheap cost to borrow and very low overall volatility in the markets were a great solution for many investors. If we look at how that's going to play out going forward, first of all, obviously cost to borrow very, very high now. And so that gives you a much higher hurdle in order to get those enhanced returns. And also, again, as you mentioned, equity market volatility is still high. Not everyone really wants to take on that added risk of a leveraged portfolio. So I think investors should look at many smart ways, as many smart ways as they can to maybe emphasize or enhance that return potential without taking on extra risk. And so that's what accelerator ETFs are really designed to do. In a similar way to those buffer ETFs, creating a defined outcome over a certain period of time, accelerator ETFs offer an investor 2 times the upside of a price return of an asset. And again, this could be the S&P 500. We also have a second accelerator ETF that's based on Canadian banks. And so investors can choose what underlying exposure they want here. But if you want either the S&P 500 or equal weight banks, and accelerator ETFs offer 2 times the price return plus dividends over a period of time. And for accelerators, it's a 3-month outcome period that we have. And again, there's a price cap involved. And so you get 2 times that price return up to that cap, up to a certain level. And if it doesn't work out and the markets are down during that period, you only have single downside exposure. So it's a very risk-controlled way of getting that extra upside potential without taking on any extra downside risk.
Okay, and similarly, how we did with the buffers, can you walk us through the option strategy and how that works behind the scenes?
Yeah, sure. And so again, first thing we do is we go out and we buy that underlying ETF that we want exposure to. Again, ZUE as an example for the S&P 500. And then again, we layer on an options package, this customized option package. Only this time, instead of first going out and buying that protective put spread like we do for the buffers, for an accelerator ETF, we go out and buy a call option. So buying a call option actually gives you more upside exposure. So we already have an investment in the underlying ETF, that underlying asset, and then buying a call option on top of that provides a double exposure, which is what I was talking about in your previous question. Now, again, that call option has a cost to it. There's a cost outlay to go out and buy that call option. And so in order to finance that, again, we are selling upside call options. In this case, we're selling 2 upside call options. And that would have the impact of capping both the investment we have and also capping that upside call option that we've purchased. And so those 2 call options, again, act as a cap and pay for the cost of that at-the-money put option that we buy. And so for this 3-month period, again, we have a costless option package that gives us this nice structured outcome that's known in advance for investors.
So Chris, what's, again, similar to what we did with the buffers, let's talk about what that investor experience is intra-period, if they were to sell before the period where it was up.
Yeah, and so again, let's think about a generic example, and the outcome periods, as mentioned, for accelerated ETFs are much shorter than that buffer ETF. It's not a 1-year period; it's only a 3-month period, and so for that investor that's invested for the whole period, again, you're getting 2 times that price return. And so if the market was up 2%, let's say, the investor that holds this through the entire outcome period would be up approximately 4%. Again, you're collecting dividends as well along the way, so total return could potentially be even higher than that. But you're getting that sort of double upside. The only scenario where you're really losing is more of an opportunity cost. If the market really goes up very strongly over that 3-month period, let's say it's up 10 or 12% during that 3 months, eventually the accelerator ETF will hit that cap that's in place, and so you would start to lag the underlying market in that scenario. So again, I think it's important to note that only really happens in those very strong bull markets. For the most part, what you're trying to do is enhance or emphasize that first few percent of return that the market provides.
What was the thought process around the 3-month outcome period for these versus the 1 year for the buffers?
Well, I think there's a couple of things at play. First of all, we'll go to the buffer side. I think it's very natural for investors to understand over a longer term period that they have something in place that's going to protect them against the market downside. For an accelerator, I think investors have a different objective here. They're looking for, of course, that upside participation. Now, I think we've talked a little bit about how intra-period, these options still have some value, and the full intrinsic value of the option is not unlocked and it's not realized until the end of that outcome period. And so for investors in an accelerator ETF, if that outcome period was too long, it would actually take a long time to realize that full upside potential. Think about someone that wants the Canadian banks and thinks, I'm going to get double the upside here because I think this is a great investment at this point. If the market rallies early within that longer term outcome period, those options are still going to have value, and you're not going to be as close to that predefined structured outcome as you think you will until it gets much closer to the end of that outcome period. And so by shortening that outcome period for accelerator ETFs, investors will be able to realize that double upside that they're hoping for in a much quicker fashion.
Perfect. Thanks for that. So again, ZUEA, the BMO US Equity Accelerator Hedge to CAD ETF, and ZEBA, the BMO Canadian Bank Accelerator ETF. So again, both the buffers and accelerators can really be used as that core portfolio holding. This more so for that growth investor. Can be used as a leverage alternative, right? As you mentioned, the cost of leverage is increasing, volatility is increasing, so a more risk-controlled approach to gaining that potential 2-time price return exposure, or as a tactical exposure. And again, there's more information to be found on our website under those PDFs. If you search the ticker, if you are looking to purchase these, especially intra-period, check out that as well. So Chris, thanks. I think we did that in a great time. I know there's going to be more questions. So again, put them in the comments below so that we can have Chris back and dig even deeper into these new solutions. But we wanted to give you that higher level intro to these innovative solutions. They definitely give investors much greater choice to influence that sort of full range of potential outcomes of their portfolios, and a great new tool for portfolio construction. So Chris, I'm sure you'll be back soon. Next week, we are going to be discussing tax loss selling with tax expert John Waters. So this is an episode we do every single year around this time, around how ETFs can be used in a tax loss selling strategy to crystallize some of those losses in your portfolio. And we'll highlight some of the areas of the market where this might make sense. So we'll hope you join us then. Thanks for joining us today, and we'll see you next time.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.